Thanks again, and thanks to everyone for coming. This is joint work with Amaray Riggs-Cragen, my colleague at the University of Chicago. This is a pretty new paper, and so we're really looking forward to your feedback and any suggestions you might have. So to motivate this, I want to begin by going back to the seminal contracting theory paper, Holmström 79. And the central insight from that paper is that optimal contracts should behave as if the principal is making inferences about the agent's action. And this central insight is going to have very far-reaching implications that permeate basically the entirety of the agency theory literature. So let me just list a few of them. Rather than picking them arbitrarily myself, let me go straight to Lambert's 2001 JAE review paper. And I'll just go down the list in section 2 of that paper and name the implications that he felt were most important following Holmström's analysis. So the first thing that he brings up is the informativeness principle, which is in Holmström 79 itself. And the point here is that any signal that's incrementally informative about the agent's action should be included in the contract, and therefore we would expect contracts to be rich and based on many variables in practice. The next section that Lambert talks about has to do with linear aggregation. So Banker and Datar in 1989, they derived conditions under which many signals can be aggregated into a composite measure, and then the contract can just be written on that aggregate. And their main result is that in this aggregation process, signals should be weighted by their sensitivity and precision with respect to the agent's action, or essentially how informative the individual signals are about the agent's action. This is going to imply that equally weighted accounting aggregates like total revenues or net income, or value relevance weighted aggregates like stock price are going to be inefficient aggregators for contracting most of the time. In the next section, Lambert talks about relative performance evaluation, pointing out that even though the agent can't control pure performance may still be useful in the contract to help us filter out common shocks and obtain sharper inferences about the agent's action. So I'll stop there in terms of implications and turn now to recent evidence that provides perhaps some support, but perhaps some mixed support for these central predictions in agency theory. So first of all, in terms of the number of performance measures in the contract, the median number of performance measures in S&P 500 firms is only 3. Over 90% of performance-based awards are tied either to accounting or market aggregates, which the theory predicts are using the incorrect weights. And fewer than half of firms use RPE in their contracts, and the firms that do use RPE seem to be using it for reasons other than filtering out common shocks. So what we do in this paper is we go back to the foundational moral hazard model, and we notice that the classical results are derived in a setting where the agent's action is restricted to a set of parameterized distributions. For example, the set of normal distributions with a common variance where the agent is perhaps choosing the mean. We think that in practice, at least it seems to us, that agents can take actions that affect higher moments of the firm's performance in many cases. For example, an executive might be able to affect the variance of performance by choosing a portfolio of projects with different degrees of risk. He may be able to affect skewness by identifying projects with skewed payoffs, like different types of research and development projects. And he may be able to engage in activities like real activities manipulation around thresholds, like analyst forecasts to try to beat targets. And these are just a few examples. We think that in practice, especially CEOs and agents in the C-suite probably have a very rich set of actions available to them that affect the firm's performance. So what we do in this paper is we expand the agent's action opportunity set and go back to the original moral hazard setting from Holmström 79 with this modified assumption. And we show the existence of a class of agency conflicts in which the optimal contract behaves as if the principal were making inferences about outcomes she values rather than about the agent's action. And this slightly different insight is going to have far-reaching implications, we think. Rather than talking about those now, let me go ahead and jump into the model and present the results, and then I'll return to implications at the end. So I want to start by going back to Holmström's setup. So in Holmström 79, there's a principal who cares about some outcome X. We can think about this as maybe the terminal cash flow of the firm that the principal consumes. And there's some distribution over that cash flow, F of X. And that distribution is going to be influenced through the parameter A, which we can think about as maybe effort, and that's chosen by the agent. So because the agent is taking a hidden action that's costly, but the agent doesn't consume the results of that action, there's going to be an inherent conflict of interest between the principal and the agent. To try to resolve this conflict, the principal is going to write a contract or a sharing rule that's going to specify how much the agent is going to receive contingent on different outcomes. So for example, if this contract becomes steep so that the agent gets a lot more when outcomes are good than when they're bad, the agent might improve or take a better action A. More formally, the agent's going to choose the action A to maximize his expected utility from the contract minus the cost of effort. The agent's first order condition is given by this expression. And under some restrictions on the problem, this first order condition will be necessary and sufficient for a solution. Okay, so the only other thing I'll point out here is that there tend to be many contracts that satisfy this condition. So there's a very large incentive compatible set in the classical setting. Before going on to the principles problem, let me show you what we do. So we're going to borrow an assumption from section 2 of Holmström and Milgram 87 and assume that rather than choosing a parameter in the distribution F, the agent's just going to choose the distribution F directly. So the agent's program formally is going to look like this. The agent chooses F to maximize his expected payoff from the contract minus the cost of implementing the distribution F, subject to a constraint that F is a PDF, right? As opposed to, we could think of an analogous constraint in the classical setting that F is in the set of parameterized distributions. Okay, the agent's first order condition in our setting is going to be necessary and sufficient for a solution. Before I get there, all we really need on the cost function here is that it's convex and that it's twice differentiable. There's a large class of cost functions for which our results hold. I can talk about that later. For now, I'm just going to assume this very tractable quadratic cost function. So given this cost function, the first order condition is given by this expression. And you'll notice that f of x is going to be monotone in s of x at each x. And there's going to be a first order condition at every x. The agent's choosing f at every single point here. And so it's going to be very easy for the agent to game any nonlinearities in the contract. So for example, we can capture things like mean shifting when the contract becomes steeper, but we can also capture things like taking riskier actions in response to convexity in the contract. Right? The agent gets a higher payoff when the outcome is high, and a lower penalty when the action is low, and that increases incentives for risk taking. The opposite happens if the contract's concave. We can also capture gaming the distribution around a threshold, where the agent could take actions like real activities manipulation, where maybe there's some sacrifice in the unconditional mean, but the probability of just beating this threshold is very high. Right. So this formulation is going to allow us to capture a very flexible set of actions that the agent could take. All right, let me move on to the principles program now. Under the classical approach, the principal is going to design a contract and propose an action to maximize her expected surplus, subject to a couple of constraints. The participation constraint ensures that the agent is willing to work for the agency. It says that the agent's expected utility is greater than or equal to his reservation wage. And then the IC constraint here is going to ensure that the agent is willing to take the proposed action. This is just the first order condition from the last slide. So the principal's first order condition with respect to S at X gives us this iconic characterization of the optimal contract from Holmström 79. Specifically, it says that the ratio of marginal utilities should be equal to a constant plus another constant times the likelihood ratio. This likelihood ratio is going to award the agent a higher payoff when X indicates that it's likely that the agent took the desired action, and a low payoff otherwise. And this is what I mean when I say that the optimal contract behaves as if the principal is making inferences about the agent's action. It's all coming through this likelihood ratio. In our setting, the principal setup is basically the same, except now there is a different incentive compatibility constraint at every X. Right? So there are many of these IC constraints. And the first order condition with respect to S at X is given by a very similar expression. The ratio of marginal utilities is equal to a constant plus mu times the likelihood ratio. The main difference being that there's a different mu for every action, right? For F at every X. What this is going to imply is that there's an interaction between the conflict of interest and the likelihood ratio piece. Recall that for a Lagrange multiplier on the IC constraint, we can interpret this, loosely speaking, as measuring or indexing the magnitude of the conflict of interest between the principal and the agent when it comes to F at X. So we can actually solve for mu of X by taking the first order condition with respect to F at X. And if we do that and substitute that expression in here, notice that in the denominator, we have C of X times F of X, and that is just this right-hand side of the IC constraint. So we can substitute this constraint in, and F has disappeared from this solution, right? Likelihood ratios have been replaced with a function of the principal's objective. Okay, let me keep going a little bit more before I elaborate on this. The next thing that Holmström does is he says, suppose that there are some other performance measures, Y, that are available for contracting, right? So the agent still chooses A, and that's from an interval or from a curve, and that's going to determine the joint distribution over X and Y. And Holmström asks, under what conditions will Y be valuable for contracting? If we go through the same steps as before, this expression characterizes the optimal contract. And you'll notice that Y or S is going to vary in Y if and only if this likelihood ratio varies in Y. And this likelihood ratio is going to vary in Y if and only if some component of this vector Y is incrementally informative about the agent's action. So this is Holmström's informativeness principle, that we should include any performance measure that's incrementally informative about effort. Okay, in our approach, the agent's going to choose the distribution directly rather than choosing a parameter in the distribution. And so if we set up the same problem and take the first order condition, we get a very similar expression as before. The only difference here is that instead of having X in the numerator, the principal's objective, we're going to have an expectation of X conditional on all the information in Y. All right, so if we compare these two expressions, you'll notice that in the classical approach, the contract is written as if the principal is forming inferences about the agent's action through the likelihood ratio, whereas in our approach, the contract is written as if the principal is forming inferences about the outcome that she cares about, X, taking the agent's equilibrium action as fixed. Right, and that's going to be the main result in our paper. The last thing that we do, just a few more minutes here, the last thing we do is we consider what happens if the principal cares about many things, right? So following Banker and Datar, or kind of generalizing that, we can imagine that the agent chooses A, and that affects the joint distribution over a vector of things that the principal cares about and over a vector of performance measures. The solution is going to take the same basic form. We still contract on Y if it's incrementally informative about A under the classic approach. And in our approach, we get a very similar solution. It's just that X has now been replaced with B of X, the principal's objective function in this expectation. Now, what Banker and Datar do is they ask, under what circumstances could we write the contract on an aggregate instead of on the entire vector Y? And they notice that this likelihood ratio is essentially an aggregator of information in Y. And so solving this for S of Y and then substituting in the likelihood ratio, we can write a contract on a single aggregated measure, which is the likelihood ratio instead of on the vector Y. Then Banker and Datar, they ask under what conditions will this likelihood ratio be linear? Like net income, for example, is a linear aggregate of revenues and expenses. Well, they show that the existence of a class of production functions F under which this is the case, and they show that the weights on these measures are going to depend on the sensitivity and precision of these measures to the agent's action. By contrast, in our approach, the aggregator is going to be the principal's objective or the expectation of the principal's objective. And if that objective is linear, then this aggregator will be linear. And in this case, we can decompose this contracting process into 3 steps. First, we use all the information in Y to form an estimate of the things that the principal cares about in X. Then we aggregate up the elements of X using the weights in the principal's objective, B. And then we write a contract on this aggregated estimate. So this has some immediate implications. When it comes to accounting aggregates, if we define revenues, expenses, gains, and losses as equally weighted changes in shareholder wealth, then an unbiased estimate of net income is an optimal aggregator for contracting. So more specifically, if we have a vector of revenue items and a vector of expense items, and if the principal cares about income, right, the difference between the sum of revenues minus expenses, then we can estimate all of those individual items individually, and then aggregate them up using equal weights and contract on estimated net income. What about contracting on measures like price? Well, first of all, if price is the principal's objective, then it's the only measure in the contract in our setting, even if there are other incrementally informative measures about the agent's action. By contrast, if price is not the principal's objective, but it aggregates information about the principal's objective, then price is an efficient aggregator if the agent chooses the joint distribution over X and Y, or if price incorporates exogenous signals as well, then price can still be an efficient aggregator as long as the agent chooses the distribution f of x, y conditional on those exogenous variables. So for example, if the agent can hedge against exchange rates or input prices, then we wouldn't want to filter those things out of price. Price would still be an efficient aggregator. Finally, if we had some exogenous measures like peer performance, and the agent chooses the firm's exposure to, let's say, some common shock that affects focal performance and peer firm performance, then we don't want to reference Y in the contract either. Again, we're not trying to form inferences about the agent's action. We're trying to form inferences about outcomes the principal values. But there may be another use for RPE in our setting. If X is not contractible, then Y might be useful if it's incrementally informative about X. So that's it. I think I went a couple minutes over. I'm sorry about that. But the main takeaway here is that when we enrich the agent's action set in the classical model, we show the existence of a class of problems under which the contract behaves as if the principal is making inferences about things that she values rather than about the agent's action. And to the extent that the classic informativeness principle permeates most of the agency literature, we think this result is going to have similarly far-reaching implications, some of which we discuss in the paper, but others we haven't yet had a chance to explore too much.